Hey, everybody, Kevin here again with another episode of the Real Estate Without Renters podcast. Thank you, as always, to listening to the show and recommending it to a friend. We do appreciate that. I'm also joined by my friend Dave. How you doing, Dave? And we have a guest for you today as well, which we'll introduce in just a minute. But if you've been following along on this series, you know that Dave and I have been going through and identifying things within the economy and relating that back to real estate and real estate notes. And it's so important to what we do. Both Dave and I and our guests have seen cycles in business, cycles in real estate notes. And quite frankly, I can speak for Dave and I because we've talked about this. Dave and I both got caught in some turmoil in other crashes and things like that. And when you're a full-time investor, hey, let's face it, if you're all in, sometimes those things happen, but hopefully you learn from those. And that's what we're really trying to share here, is not just showing you the potential of what could go wrong, but how to best position yourself within that, and also how to profit from that, because you can't just fully sit on the sidelines and watch everything go by and try to time markets out. That it simply just doesn't work here. So do want to thank my sponsors once again. So if you're interested in live events, I've got a couple of things coming up here. I just want to share with you real quickly. I get asked that all the time. My next event that I'll be doing live is on alternative investments, along the same lines of what we're doing in this podcast, which is talking through and talking about what do we do, how do we best position ourselves in so-called alternative investments. Now, obviously, I'll be focused on real estate notes, and then we have a good lineup of speakers here in different areas of real estate and other alternative investments that I think you'll really enjoy. So if you want to come see me at that event along with these other instructors, that'll be in Buffalo, New York, coming up at the end of this month. And for those listening on the podcast, there's a URL that you can get by going over to the YouTube channel. Again, the YouTube channel that we're rebroadcasting this on with full video is on my YouTube channel, which is just go to Google, search my name, Kevin Shortle, and you will see my channel there. Go ahead and subscribe to that. The whole 2-day training here right now is $79 until July 10th, when it goes up to $279. So take a look at this if you're interested in seeing that and coming up to Buffalo. I'll be there the whole time and probably be speaking for a couple hours on that. I'll have another one coming up with Noteworthy, one of my sponsors, NoteworthyUSA.com. That'll be further down the road in October here in Orlando. So I'll keep you updated on those. And of course, I'm joined first of all by David. And again, Dave is been doing this with me. So if you haven't listened to these in order, I really recommend that you go back and do that, because we're taking this in a very logical approach. So Dave and I have spoken already about inflation that led to a discussion in recession. And then we were talking about the real estate bubble potential. If real estate prices go down, how do we handle things in the third one? And on this one, we have our special guest that we're going to introduce here in just a moment. So first of all, let me say hello to Dave. Dave, how are you?
Great, Kevin. How are you? Great.
Just fine. Thank you. Ready to get rolling today. You've invited a good friend of yours. So why don't you do the honors of introducing Howard for us?
Okay, I brought Howard Tenn. We've known each other, gosh, Howard, 5 or 6 years now with Asian Night Digital Systems. And Howard's been a wonderful mentor for me, coach. He knows his stuff. He's been around the block more than once. He's got his scars like you and I have. Mm-hmm. And we, in our pre-call, he said some really good things that I think the folks are going to identify with, and he'll have some solutions in mind too, because we want this to be a solution-oriented call to take advantage of what we all know is coming. But Howard knows his stuff. Howard?
Hi, Dave. Thanks, and both to you and Kevin for inviting me here to share my ideas. And so let's get started. So
what else can you, before you jump right in, Howard, can you give us a brief background of where your experience level is coming from for those who don't know?
Well, I have been in the financial world for over 40 years, and I started out in Canada just as a basic financial planner, sat down, did budgets. Back then, Charles Schwab was launched. And we were basically buy term and invest the difference, and they were buying mutual fund. And then I went from that to actually constructing portfolios. And then in 1987, when we had that big crash, everybody said you couldn't see it coming. I did not believe that. I said this, that you got to have seen it. And that launched my career in technical analysis. And then I moved to the United States back in 94. I took a year off, studied the markets. I studied a lot of markets and trade the markets, trade stocks, bonds, futures, currencies. And then I had my kids. I took 14 years off, but I'm an engineer. So I got bored. I got into remodel, fix and flips. And then I decided my kids didn't need me anymore. And then I get into lending. So right now I'm a lender. And that's when I met Dave. About 7 years ago,
Yep.
At a note conference, and I decided to enter it not from buying notes, but from lending money to people to buy notes. Mm-hmm. And I'm probably one of the very few people who know how to do that. Mm-hmm. I loan money to someone to buy 100,000 to buy second position, non-performing, in which they couldn't do anything for 6 months. They couldn't touch it. They couldn't call on it, on anything. And I loaned them the money. Mm-hmm. And they paid me back.
Great. And what I really like about your background and why I wanted you to do that, by the way, is, what we're doing this special series, Dave and I, about is overall economy. And we kind of fall in that category of alternative investment still in the note world, at least as far as public perception is. But your background is really coming from all different investment levels. So your awareness has to be not just focused on real estate and real estate notes, although you're leaning that way now, but really coming from a stock background and everything else. So I think it's very well rounded that the experience that you have, that you can talk about these various scenarios that are being set up. And I'm really looking forward to this, because you had mentioned that you have one slide that you're going to focus on in this presentation. And so we're going to try to describe that slide for you visually for those who are just listening on the podcast. But once again, you can see the full video on the YouTube channel as well. So I'm very intrigued by this slide and what you're going to say. So give us the origins of where you got this slide and kind of set up what you're going to tell us about and how important this slide may be.
Okay. Well, you can get the data from anywhere that will show you the 10-year Treasury yield. Mm-hmm. But this particular slide, what I did was, anyone who ever looks at a chart, the markings or the candle are period. So every candle on this chart represents 1 month. And so it pulls all the way back to roughly 1982. Mm-hmm. And then what I did was I put a moving average, a 200-month moving average. So if you divide 200 by 12, this is 16 years. So you will see a red line, and that red line is showing you what's been going on since 94, and you will see it's been going down. Mm-hmm. So,
and this is just to be clear to everybody. So what we're looking at on this chart is the 10-year U.S. government bond rate. Is that right?
Yes.
The percentage rate. If somebody were to buy a bond with a 10-year bond, this is the rate that they would get at any point in time. And this goes back to 1980-ish all the way to current. And then you took the averages starting in 1994 of what those bond yields are. And I can tell you, everybody, visually, and you can see this on YouTube, it's just a downward trend. That's for sure. Okay, go ahead.
Why the 10-year yield? And this is really something that is extremely important to understand. The 10-year yield is what the U.S. government uses to finance all its operation. But more importantly, it is considered to be the most safest and liquid investment out there. And because of that, it is the index that determines the interest rates, not just for mortgages, not just for cars, not just for credit cards, but when countries are lending to other countries, when banks are lending to other banks, it is what they call the default index for loans all over the world. And this is extremely important because so goes the 10-year yield, so goes the economies of the world. And I don't want to get into the nitty-gritty of this. I just want you to understand how important that is. And I want you to see that it's been going down. And now in the background, you will see these what appears to be pink lines. Mm-hmm. And so starting from the bottom going up, what I did was I put these bands, and these bands are 1.5% bands. So it starts at 0.5, and then I go up to 1.5. So that actually is 1.5. It's about 1%. That's a 1% jump. And then I start the next one at 2 and went 1.5, and then I jump another 1%. So what you're seeing here are these bands, and the bands are sprung right across the entire map. And what it really is telling you is pick any point in time that you want in the band and go across from right to left. And you will see where the chart is, and then you look at the date within that time, and that's how much interest rate were. So let's take the 6 to 7.5% rate on the 10-year, and we go all the way across. We can see that somewhere between 94 and 98, that's even 1990, and we can see that. Why that is important? Because in order for it to make sense to you, I then do something that is represented by those vertical lines. If you pay attention to, first of all, I took August. So you'll notice all the way across, it's roughly August. And then you see 86, then you see 90, then you see 94, then you see 98, then you see 2000. So what is happening here is what you're seeing are 4-year cycles. Midterm elections, that's what that is. I call this the presidential cycle. But what I did is I could have used the actual presidential cycles, but I didn't want to do that. And the reason I didn't want to do that is I didn't want to make this political. And so I decided not to do this. And so if we look at that, what we're seeing is just pick any 2 cycles, and you can see it goes up, it goes down, it goes up, it goes down. So for instance, let's go back to 2008, leading up to 2008, August 6th, you can see that the interest rates were high, and then by 2010, you see they're lower. Well, what is happening is if you look very deeply into it, you can actually see where 2008 actually hit, and the interest rate dropped, because when the economy starts to collapse, the feds react, and they react fast. But what people don't realize, going back to the great financial recession, what happens? Rates were rising up until 2006. And for some unknown reason, it starts coming down. And in 2008, bam, it hit. And it continued down until somewhere about 2009. And then it starts going up again. And then it comes back down in 2010. And then it keeps going down, and it keeps going down. If you study, just look at each little band, because this is the midterm elections. So let's move to today. The midterm elections are coming up. We're in the midterm election, and we're seeing the interest rates going up. And for the first time since 98, the 10-year yield has crossed over the 200-month moving average. And so the question is it going to keep going up, or is it going to come down? It is my opinion, looking at the pattern, is that within the next 6 to 18 months, it will come down. It will come down. What that means, it will come down because the inflation will start to come down, and the inflation is going to come down because asset prices are going to crash.
Mhm.
They're
Okay.
going to crash.
And Howard, what you said, did you say asset prices are going to crash?
Yes, asset prices are stocks, bonds, real estate, businesses, not so much commodities, although they will have a knee-jerk reaction, but it will come down because the feds are going to do everything they can to wring this out. But must remember, the Fed is only one part of this thing. We have fiscal policies and we have monetary policies, and the feds cannot do this by themselves. The Congress, because we must remember, it's the Congress. It's not the president who has the purse string. It's the Congress, and that is why I went with the midterm elections. And so it is. Go back to the 70s. Look what happened to Jimmy Carter. You know, probably one of the most brightest, honest men, but he couldn't rein in inflation, and so boom, he was out. Mm-hmm. I really wanted to stay away from president because the moment you mention one of their names, everybody goes bonkers. Yeah. But and then they miss the point of your what you're trying to get across to them.
So let me get this projection. Let me get this projection right here. So what we're essentially looking at, once again, everybody, is the U.S. government bond rate, the 10-year bond rate specifically. And on the chart since the 80s, it's a steady downward trend overall through present time here. The chart showing everywhere from 16% then down to less than 1% and now up again. So then you've divided that into 4-year increments, looking at the August timeframe on that. And it is interesting how that does show there's a little kick up and kick down. It's a pretty interesting trend. I see the crossover there where it went over the overall the average trend that you have there. So getting down to where we.
It's 200 months, which is 16.6 years.
Okay. So getting to where we are now, it's crossing that red line for only the second time that I can see in 16 years there. So by your projection, once again, based upon these overall trends, you're saying we're going to continue to see rates go up, but there's a time frame of, I think you said 12 to 18 months. Am I wrong?
I would say 6 to 18 months, somewhere in there.
So anywhere from 6 months to 18 months where we're going to see the rates go up, and then you're predicting that it's going to start to slide down in line with the overall trend. Is that right?
Yes, but that it will not come down unless asset prices come down first. I just looked at something and it said a mortgage rate at 6% can support a house at roughly 15,000 at 6%. A mortgage rate at 3% can support a house at 450,000. If
you're looking at a certain payment amount.
Correct.
Yeah.
And that is really important to understand. Mm-hmm. And how I use this to advise a lot of people on a lot of things, but as it pertains to notes, you have to have somebody and understand how to do the math. And that's where you would come in, Kevin.
Mm-hmm. Hey, everybody, I had to break this into 2 parts. In the next part, we're going to talk about some of the upcoming opportunities that you are going to want to be a part of. So enjoy.